Welcome to Taking Stock for the week ending 5th of December 2025. I'm Tim Lincoln, and joining me today is Kien Trinh, our Head of Stock Doctor Research. Welcome, Kien, and how are you?
Great, Tim. I can't believe, December's here now, and we're all kind of working our way towards the holidays. And how are you, Tim? And what have you got planned?
Yeah, I'm great now, Kien. Had a bit of a health scare not so long ago with the old ticker playing up a bit, but no, good as gold now, Kien, and can't wait to have a lovely Christmas period
Hmm.
and looking forward to hopefully another bumper 2026 for the markets. Anyway, Kien, before we get started, just a reminder to all of our members that all of the information we share today is of a general nature and shouldn't be construed as personal advice, and all the data, performance metrics, etc., that we also share, all historical, shouldn't be relied upon as a guide for future performance. But as you said, Kian, it's really hard to believe that we're in December already. This year just seems to have flown by. But it's been one of major change for our business with the merger with Prime Financial Group, which is going really well. But I love the fact that our members have now got access to a broader suite of services beyond equities, but it's the equities that we love. But Prime Financial Group love a diverse array of other investment products, including accounting services, self-managed super fund administration, access to alternative assets like property, some wonderful property developments that you can invest in and diversify, and even you can invest in some sporting teams as well from an alternatives perspective. So a beautiful diversified mix there. If you'd like to learn more, just click on the Prime section of Stock Doctor and all those peripheral services are available and mentioned there. But turning our focus now to the markets, Kian, and star stocks, of course, November was a challenging month for investors.
Yeah, Tim. The All Ords Index, it fell 2.5% over the month, and that trimmed the year-to-date gains to around about 5.8%. But our star stock portfolios, they held up pretty well. Star growth stocks outperformed the market by 1.4% for the month, and is now up around 15% for the year. And during the month, that was supported by strong performance from some of our gold producers, Tim, like Genesis Minerals and Capricorn Metals, as well as our lack of exposure to the banks, which weakened as concerns grew around stretch valuations.
Yeah, I love the outperformance over the last year, Kian. Our star growth stocks have certainly done incredibly well, really helped by the timing that we nailed with the fundamentals of those gold producers really turning with gold price. So again, just following the simple bouncing ball of the fundamentals of companies and those economic and industry shifts have paid certainly wonderful outcomes for our members in the last 12 months and beyond, of course, over the long term. Meanwhile, Kien, star income stocks performed broadly in line with the market from a total return perspective during the month of November, but have outperformed beautifully over the full year with really strong dividends, really delivered by companies like Challenger and APA. But the lack of exposure to CSL also helped with the income fund from a benchmark comparison perspective. And really importantly, from a star income stock perspective, it's all about yield, isn't it? And providing members with that nice sustainable stream of income. And star income stocks produced a 6% yield. That's a grossed up yield to date, comfortably ahead of the market's 4.4%.
Yeah, it's great to see star income stocks start to outperform now for the year to date, Tim, especially over a period where interest rates were quite elevated, but things are starting to turn around, which is great. But turning now to the markets this week, it's been quite a choppy one as investors digested conflicting economic signals. You had softer than expected GDP figures, but that coincided with stronger than expected household spending figures. So on balance, though, the market is pushing out expectations for rate cuts or even a rate rise into next year, Tim.
Yeah, it's all a bit of a yo-yo to me, Kian. All of the macroeconomic data, it's,
Mm.
recession fears one week, off the next, interest rates rising one week, off the next,
Mm.
inflation figures and then job figures. It's all a bit of a yo-yo. So for me, it's always, as I've abided by, is to block out the noise and focus on the fundamentals being the true quality of an organisation, the true quality financials. And whenever the market sells a high quality business on macroeconomic noise, then this often represents great opportunity. And this has certainly been the case with companies like Pro Medicus, one of our long-standing star growth stocks, amplified wonderful prosperity in many of our members' portfolios over a long period of time. The share price has drifted lower despite, some great contract wins. So obviously representing opportunity now in Pro Medicus as far as we're concerned. But Kien, what's currently driving that weakness in Pro Medicus?
Tim, as you've mentioned, it's less about those fundamentals and more about market sentiment, really. You
Right.
had, during this period, high growth, high valuation companies like Pro Medicus, they are more sensitive to rising bond yields. And we've seen profit taking across the entire growth sector, not just Pro Medicus. But importantly, the recent data breach speculation appears isolated and fully contained, especially regarding Pro Medicus. And as shown in Stock Doctor, you can see that earnings revisions remain positive. Profits are still expected to grow more than 30% over the next 2 years. And that's reinforcing its strong fundamentals.
Yeah, fascinating stuff, Kien, isn't it?
Mm.
So that again, that noisy influence creates that opportunity in many businesses right now. So let's now move to the financial sector, Kien, and insurance broker AUB. AUB is a star income stock, and they saw a very sharp share price drop after announcing its takeover discussions had ended. That's disappointing for shareholders, Kien, but does it signal deeper issues for AUB?
In this case, Tim, not necessarily. AUB, they confirmed that their bidders, EQT and CVC, they walked away after due diligence, but did emphasize that $45 per share already reflected the fair value. And importantly, there was no indication of operational problems uncovered. Management did reaffirm their financial year 26 net profit guidance of around 215 to 227 million. And that implies 7 to 13% earnings growth. So very strong growth still coming through.
Yeah, very interesting, Kien. And from an income standpoint, dividends remain really well supported. Financial year 2026 dividend expectations employ around 10% growth, backed by a conservative 53% payout ratio and now a more attractive fully franked yield of around 3.3% after that share price pullback. And now to Under the Microscope, Kien. And this week we're putting ex-Star Growth Stock, it was a Star Growth Stock many years ago now, corporate travel under the microscope. And there's a lot to unpack here, Kien. Let's start with the obvious. Corporate travel has been in a lengthy trading halt now. What's actually behind the trading halt, Kien?
Well, Tim, the trading halt is tied to a major accounting issue in Corporate Travel's UK division. A forensic review has revealed that corporate travel overcharged its British clients, including what is widely believed to be the UK government departments, by around £80 million. And that revenue will need to be reversed and large refunds paid.
Oh, sounds nasty, Kien. And will this potentially have a negative impact on their financial health?
Well, corporate travel did insist that its solvency isn't at risk at the moment, pointing to roughly 148 million in cash balance and no drawn debt. But the damage goes far beyond cash flows and balance sheets. The reputational fallout will shadow the business for years, with guidance withdrawn now, and its UK Europe CEO, he's been stood down pending a governance review.
So considering all of this, how does the previous set of results still lead to neutral earnings quality rating?
Well, that's a great question, Tim. But really, if you dig deeper, the issues are isolated only to the UK. You've got cash flow and revenue recognition in corporate travel's other regions like Australia, the US, and Asia. They all align with actual activity. So neutral simply implies that the rest of the business wasn't overstating earnings, but it doesn't really downplay the seriousness of the UK errors.
And another key concern amongst critics is that corporate travel operates at a much higher profit margin than its peers. How is this possible in a highly competitive industry of travel bookings, Kien?
Well, Tim, look at those profit margins, quite high, aren't
Sure.
they? But management did allude that all this is due to their technology, the automated operating model. It keeps servicing costs quite low, and it also has strong exposure to government and SME clients, which typically offer better margins and economics than your global enterprise travel clients. And these structural advantages explain why margins look unusually strong, which is also why short sellers have been questioning this company.
Yeah, okay. And the short sellers have also questioned the high margins, obviously, with
Mm.
the high level of short interest on the stock close to 10% now. So real warning bells there, Kien. That can be seen under Golden Rule 4, obviously. And the bigger question now is leadership, with co-founder Jamie Ferris has presided over high turnover in senior roles, questionable insider trading transaction in past years, and now an accounting scandal that went undetected for years. So some serious issues there, Kien.
Yeah, that's incredible, Tim, how he's managed to overcome a lot of these
Yeah.
issues in the past. But unlike 2018, this isn't just about short sellers raising hypotheticals from the outside. This time, the problem is entirely of corporate travel's own making. Governance failure at multiple levels, Tim. Internal controls failed, external audits failed, and now shareholders will inevitably pay the price.
Yeah, well, Jamie Ferris, he's a founder. We often love founders, but maybe some complacency crept in there. So it's really going to be interesting to see if he rises to the fore now and tries to lead his company out of this mess. And now to question of the week, Kien, and we're bringing the focus back onto AUB and their failed takeover. A useful question and strategic question, Kien, for this week is how can investors assess whether a takeover is likely to go ahead, and should they potentially take profits beforehand after the share price has spiked on the takeover offer?
Yeah, this is a problem that I think a lot of investors face, especially if they're holding stocks under a takeover. But really, a takeover is more likely to go ahead when the price looks fair and the deal is clearly structured and conditions are less stringent. And of course, regulators are unlikely to block it.
Yeah, okay. And if the gap between the share price
Mm.
and the offer price is small, then the market is signaling that there is a high probability of the deal going through.
Yeah, that's right, Tim. That's always the case. So always look at that difference. But from an investor's perspective, deciding whether to sell and take profits before the deal ends comes down to your personal, situation, how
Yeah.
much risk you are comfortable with, and secondly, whether the small extra gain you might get if the deal succeeds is worth the big potential fall if the bid is cancelled.
Yeah, and you can hedge your bets, lock in some profits, and sell part of your holdings if you're unsure. Generally, though, I'll exit the stock on the offer. When I say generally, we didn't with AUB because we
Mm.
thought that we thought there was a higher probability that the deal going through. But generally speaking, we'll take our profits and get out of the stock and allocate those funds into other opportunities. All right, Kien. Well, that's it for taking stock this week. Wonderful sitting down with you and having a chat about stocks, the market, and obviously our deep, deep passion.
Yeah, time always flies when we're talking here, Tim, but great to have you on board again. It's been a while.
No, I'm feeling healthier than ever. It's amazing what the advancements in medicines and technology now can do to fix things up with our main organs. Just incredible. And those fixes have meant that I'm in full health again, better than ever, which is just amazing. So thank you for that, though, Kien. And just a quick reminder to all of our members that we grow from your referrals, organically. So just click on the refer a friend button in Stock Doctor to refer anyone who you think would benefit from creating their long-term wealth with a tool like Stock Doctor. So until next time, thanks a lot again, Kien. Thanks a lot to everyone for tuning in. Have a happy, healthy, and prosperous week.